So now I'm going to use this idea of a dealer, um, and because it's so big, let's write it nicely. Dealer. We know that DEA and LER has different implications, right? When it comes to debit and credit. So let's do problem exercise 2-9, okay, line by line. So part A says Casey Spade owner invested 100,750 cash in the company in exchange for common stock. So now and right from the beginning of this whole course, where in fact, I introduced this concept in the beginning videos in chapter 1, the fundamental concepts video, that every time that cash or some asset comes in, there's that other side of the story. Cash is an asset, right? In this example, for example, cash is an asset, and and you remember this fundamental idea: assets is equal to liabilities plus owner's equity. And now we have to explain where this asset is coming from. It's coming from, who's giving that? Are we getting that from loan? No, we are getting it from shareholders. So in this part A, it says Casey Spade owner. So it's the owner who's giving cash to the company. So now cash is increasing, right? And then what is happening? Cash is increasing, and which is the asset side, while on the other hand, this money is coming from owner's equity. So owner's equity account, owner's equity, or you can call it common stock account, is gonna increase as well, right? To keep this equation balanced. So I'm gonna write here common stock, common and then stock. Okay, so a shortcut for that. So this side increases, the other side increases, and we are doing is exactly remembering that fundamental equation: assets is equal to liabilities and owner's equity. And we saw this transaction in 2-9A, that the owner is invested 100,750 cash in the company in exchange of common stock. So we know this transaction happened, and all we are doing is we're keeping this equation in front of us and thinking, okay, what is happening in the company due to this event? Assets is increasing. Which asset? Cash is increasing. Cash. Remember why we are getting all these assets in the company, so that we can use those assets later on to make profit, to make money, right? So cash is coming in at this point, and we know that it's coming because shareholder owner is investing money in the company. So both these accounts are increasing, and if we know cash is part of the asset, and common stock is part of the equity account. So we know the rules are different. Whenever cash increases, it's a debit. So 100,750, and the norm is that we put debit here and credit on this side. Okay, always. We always put the account name here, and then the second account name is common stock, right? Common stock. So whenever common stock, which is the equity account, you remember that equity account, and it is here. I'm going back to the dealer, right? So it is on the right side of the and here, when its equity account, and its equity account is increasing, so we always do a credit side, 100,750. So debit must always equal credit, okay, whenever we do one equation. So we did this journal entry for this transaction in part A, this event, and this journal entry, all it represents is an event on a certain date, and we translated that event in English sentence into an accounting sentence in terms of debit and credit. So if I don't know any English and I'm just looking at this journal entry saying cash debit and common stock credit 100,000, then I don't know what is happening, right? If I have never seen part A of this example, what I'm gonna do is I'm gonna translate now accounting into English. So I'm gonna say cash is increasing by $100,750, and common stock is increasing by $100,750. So I can understand that, okay, this owner has invested money into the cash. Once I see once I translate debit and credit. So this is why these are so useful into accumulating information, okay, information about the company.